When you think about your money, what are some of the things you wish your money could do for you? A lot of people, if I ask them what the perfect place would look like for their money, to warehouse their money, they always give me words like, oh, I'd want it to be guaranteed. I'd want liquidity. I'd want it to be tax advantaged or tax free. I'd love that money to grow at a decent rate of return. Some people that are more educated say, I'd love to earn uninterrupted compound interest. Other people say, I'd love it to not be correlated to the stock market. So when the markets go down, I don't have to lose any money or have my interest rates change. Some people say, I'd want it to be private. I wouldn't want to have to report every year and have other people know where my money is. And it just goes on and on. So when you ask your question, where is the best place to store your money? Well, where is it? Is it right now in a bank account, a savings account? You got that money in a money market? Because if your money's in any stock market related product, a 401k that's in mutual funds or anything like that, you're probably thinking, whoa, this sucks. But what we're going to talk about today is two things. Another place where your money could go. A place where the wealthy put their money. A place where the banks put their money. A place where large corporations put their money. But I'm not just talking about all their money. I mean their safe money, their guaranteed money, the money they can't lose. Then we're going to talk about a process. We're going to talk about a process of you making your money work for you. A process that's commonly called the infinite banking concept. And it is a process, not a product, to be very clear. So those are the topics we're going to hit. And we're going to really dive into the pros and the cons of the infinite banking concept. My name's Chris Naugle, and this is What Now? What's Next? See you on the inside. So I figured I'd kick this episode off with talking about some negative things. Kind of a negative world. People are pretty negative. There's a lot of people like this, that, and the other thing. Nobody's really all that positive. So what the hell? Let me just give back what I get on a day in and day out basis. Let's talk about the bad. Let's talk about the negatives, all the cons. Who cares about the pros? Nobody wants to hear the good stuff, or well, hopefully some of you do. So let's talk about my prior life. I was a financial advisor. I did a lot of things in the Wall Street world. I sold life insurance. I was always told sell term and invest the difference because I was an investment advisor. So I wanted to manage people's money. That's how I got paid. So Dave Ramsey's buy term, invest the difference. I'm like, heck yeah, buy term and give me the rest of your money to invest. That's how I made a living. And because of that, I went with a very narrow view on how things worked. And most financial advisors do. So I was just like everybody else. We think we know everything. I had my Series 7, my Series 66, 63. I had all those fancy numbers after my name. I had the fancy suits. I had the fancy cars. I had the big corner office. I had staff. You get the drift. I knew it all. I was one of the top 3 advisors at the firm I was at, making big money in Wall Street world. But I was also the person that thought I knew what I didn't know. But I didn't know that I thought I knew what I didn't know. So somewhere along that journey toward the tail end of my career, and I spent 16 years in, well, sometimes I reference it as hell, but we'll just call it the financial advisor world. There's really not much difference between the two, at least from my perception. You know, in there, I started hearing people talking about using a product that I knew well. Matter of fact, I thought I was an expert in it. A product called whole life insurance. Ooh, how you feeling about that one? When I heard that word, I'm like,
let me tell you about those whole life policies. Number one, they're expensive.
Now they're great if you need coverage for your entire life.
And oh, by the way, I can do one of those. I can sell you one of those. Be happy to do that.
You know, I would get clients coming to me telling me, oh, we're going to put a bunch of money into this whole life and it's designed for this concept called the infinite banking concept. I'm like,
infinite what?
You know, they didn't teach that in the Series 7. I didn't know what the heck this was, and they would tell me. And when I'd hear it, I'm like,
yeah, that kind of sounds like a scam. That doesn't work that way. I've never seen a whole life that gives you control and access of your money immediately. Matter of fact, sir or ma'am, I'm the advisor, and I will tell you there's no whole life out there that you can put money into and immediately take money out in the next 30 days. I know. I'm the pro.
You know, I didn't really want to learn about it. Some of them gave me books, read this book, read that book, and I just went about it like,
nope, I ain't got time for that.
but my clients went out and did it anyway, contrary to what I said.
Which is fine, as long as you don't take that money out of this brokerage account that I'm managing for you. You do what you got to do over there with this silly infinite banking concept.
I connected the infinite banking concept with a product called a whole life policy. I thought the whole life was the exact same thing as the infinite banking, and the infinite banking was a whole life. I didn't understand that the infinite banking concept was exactly that, a process, a concept, nothing to do with a product at all. The reason I associated a whole life with it is that's just what people talked about in their limited knowledge of this process. They always said, well, we need a whole life to do the infinite banking concept, so I just sandwiched them together like a peanut butter and jelly sandwich. I took the jelly, I took the peanut butter, and I just put them together and said, hey, this is just a product. But it wasn't. But one day, I was, me and my wife had transitioned into flipping houses. We were doing a lot of real estate. And one day I was out in Salt Lake City at this cheesecake factory downtown at the mall, meeting with this incredibly successful real estate investor. I mean, this dude had bank. He was loaded. I had seen him at some conferences and he was lending us some money on our deal. So we're sitting there having lunch and I just asked him, I said, so Mike, how do you lend all this money? Thinking, well, I have to know how you do this because, well, I'm an advisor, I'm gonna know. And he tells me, well, I lend from my banking system. And I think to myself, I'm like, you son of a pup, man, you got yourself a bank? I'm like, Mike, why are we at Cheesecake Factory? I'm thinking he must have been hungry because I would have thought we would have just met at his bank since he's got a bank. He proceeded to tell me that he didn't have a bank. He just performed the act of banking. And then when I got into it, he had mentioned and dropped the bomb. I said, what is this banking thing that you're doing? He had mentioned the infinite banking concept. I'm like, here we go. And then he said a whole life, and I'm like, yep, here we go. But then he started to explain how it worked. Now, I had ignored this many other times because the people to me, didn't have that level of net worth that really got my attention. But this guy, when he said it to me, I'm like, no, not you, Mike. Not you. There's no way they got you too. But he starts telling me about what he's doing with it. He deposits money in and he immediately takes it out and lends it out. And I'm like, how? How can that be?
I don't know.
Because I don't know a single whole life, and I'd monkeyed with it. I don't know a whole life that you can do what you just said you're doing. And Mike leans back and he says, I didn't design it. This guy Brent did. I called Brent up on the way home from that meeting, and I say, Brent, said, you got to tell me about this, and I puked. I was like a blender with a top off. And he says to me, did you watch the video? And I'm like, what video? He says, well, there's a 90-minute video that I need you to watch before we talk. First thing that came to my mind is what probably came to your mind. Negative. Ain't nobody got time for a 90-minute video, right? But then he proceeded to tell me that he wouldn't talk to me, even though I was an advisor, even though I was friends with this Mike guy who was his client. He wouldn't talk to me until I watched a stupid 90-minute video. So I one Sunday get a ginormous coffee and I walk myself down into my basement thinking, man, I'm gonna need more of this. Pad of paper, a pen, and I hit start. 90 minutes went by in a flash. 4 pages of notes, and literally my perception of how I viewed everything had changed. Prior to watching that 90-minute video, prior to understanding the different components, the process and the product, and its specially designed whole life, I only focused on the cons, costs. I was super concerned about the costs, the fees. Even though as an advisor, we charged fees for managing all those accounts. That's how I got paid. So I knew about fees, but it was always the thing I wanted to talk about. I also started to realize that to do the infinite banking concept, I had to be disciplined. I had to perform the act of banking. I couldn't just set this policy up and then put my hands back and be like, she's gonna do it all for itself. No, I had to learn. That 90-minute video taught me the process, and then I had to do. Because learning means nothing. Knowledge means nothing if you don't apply it. Well, I learned that I had to be disciplined. If I was gonna start the policy, specially designed and engineered whole life that actually did give liquidity of my money immediately in the first 30 days, unlike anything I'd ever seen, but now I started to understand it's possible. Then I had to move that money out into the opportunities. Like Mike would take loans from his bank, his policy, lend it out to me for real estate. So I had to start doing that. I had to be the bank. And I started realizing being the bank requires me to do these activities and make my money move and track it and be disciplined. So I viewed that as a con. The other thing is you have to qualify. Now I knew this because life insurance, you got to qualify financially and you got to qualify medically, but that can be a negative. With investing your money, when I was an advisor, if you wanted to invest your money with me, dude, you don't have to qualify medically. Like, let's just giddy up and go. I'll show you exactly what to do. But here, there was about a 30 to 60 day window where I had to be underwritten. I had to be qualified based on my medical conditions, which means, I couldn't do anything bad for 24 hours. I had to fast. I had to be a good boy to make sure that I got that medical, and I had to be healthy, which luckily I was. But that was a con, and it was not diversified. At least in the beginning, that's what I thought. Diversification was like a second language for me. Everything was diversification. But now, with this, I was just putting money into this whole life. There was no diversification there. There was no investments. I'm saying it was a con back then, but it was the greatest thing ever because it was simple. I hated all of those things in the beginning until I started doing it. And folks, I say that, and I started with the negative because I'm sure a lot of you have negative thoughts about this. You've been told negative things. You probably watched the gurus talk negatively about this. One in particular starts with a D, ends in an R. Yes, you've probably seen his IBC, or the infinite banking concept, is a scam. That guy, like I used to be, doesn't know how this works at all. And if you watch the video and you know a thing or two, you realize he knows nothing. Then I had to really start looking at what are the pros. Look at them. Number one, it's non-correlated. Zero tie to the stock market. The stock market goes down, you lose 50%, you keep making here. That's a beautiful thing. Second thing, it improves your cash flow and your liquidity. So when you think of liquidity, let's start there. That's a key word. If you don't have liquidity, you can't take advantage of opportunities. You don't have liquidity in your 401k. A lot of your investments, you don't have liquidity in either, because if you take the money out, there's some type of penalty, some type of tax, some types of fee that you have to pay. Here, you have liquidity of your money. You might not have all of your money available to you in the early years, but you have liquidity of whatever amount you have, which is usually between 60 and as much as a little over 90% immediately, okay? Improves cash flow. Now, how does this improve cash flow? Well, now we gotta really lean on the infinite banking concept. Let me just give you one particular thing, and I'll just do it with, let's use a couple $100 here, right? So we got some money. And we take this money and we change where it goes first. So we put it into that specially designed whole life right over here. Now, what I want you to do, and maybe we'll actually draw this out for you, is envision a circle, okay? Your money is in a little box, that whole life policy on the left side of the circle. To improve cash flow, what we gotta do is we gotta move that money, just like Monopoly. Every time you pass go, you get $200. And as you move around the Monopoly board, you pick up opportunities. You buy properties, low price, and then eventually you land in Park Place and Boardwalk. I love that analogy. Those are the opportunities, and they can be more. But let's just use a simple one. Your car, right? You have a car. Some of you lease it, some of you own it, but lots of you have car loans. So let's just focus on those of you that have a car loan. Every month, you make a car payment, right? That's what you call it, your car payment. And that money goes to somebody else's bank. True or true? Right. So remember that circle. Your money, your savings goes into a specially designed and engineered whole life. Then what we do is when we have an opportunity, that car loan, we're gonna then take a loan from our policy, which is the insurance company giving us a loan of our death benefit. Our money never leaves our account, which means it keeps earning interest and dividends, but the insurance company loans us part of our death benefit for an interest rate. Okay, and I take that money and now I pay off the car loan. Great, I no longer have a car loan. But we do one thing different. This is where that discipline in the cash flow comes in. Now, when you had the car loan, you had to make car payments. And those car payments didn't go to you, they went to somebody else. But now that we paid the car loan off, we're gonna take that car payment, and what we're gonna do is we're gonna still make it. That's right, you're still gonna make a car payment. I know you thought this was gonna be really good and you were gonna be scot-free with just paying the car loan off. No, we're still gonna make the car payment, but we're gonna then take it around the bottom part of the circle, and that car payment's gonna land back in your bank. And that car payment included interest and principal. So from a cash flow standpoint, instead of somebody else's bank getting a monthly car payment, your bank gets that monthly car payment, which means whatever that car payment is, that's money you now have to use. You can use it for anything. You can use it for more opportunities. You can use it any way you want, because that is cash flow that you didn't have before. Hopefully you get that. Next, leverage. Well, just in what I just showed you, I explained the leverage that you get using the infinite banking concept. You get to leverage assets that are in your policy. You get to leverage the death benefit, because remember I mentioned that. Maybe you didn't pick that up when I talked about the circle. When you take a loan from your specially designed and engineered whole life, what's happening is the insurance company is leveraging your death benefit. They're just advancing you part of the death benefit that they'll pay someday when you graduate and die, okay? But they're gonna pay it to you now in the form of a loan. You get to leverage that death benefit up to the amount of your cash value, because your cash value that you've built up, your deposits and interest and dividends that you've earned, is collateral. So that's how you're gonna leverage this. But there's a lot of other ways you can leverage it. You see, banks, traditional banks, the ones we're trying to get away from, okay, we're trying not to have them use our money. Banks understand whole life too, and have for a long time. Look it up, B-O-L-I, BOLI. Banks have used whole life insurance for their tier one capital for a long time. Matter of fact, banks are the #1 purchasers of whole life in this country and probably in the world. Why? Because they understand all the things that we're going over, all the pros. They also understand the cons, but they're more focused on the pros. So when you have a whole life built the right way for this, you now have an awesome asset that you can then leverage against the bank. If you wanted a loan or you wanted a line of credit, the bank will take your cash value and leverage it. They'll take a collateral assignment and you can use that. So there's all sorts of ways you can leverage this. You can just simplest form, leverage the death benefit. Secondarily, you can leverage the asset, because this is a guaranteed asset and the bank knows that. Number 4, what you're essentially doing is creating your own personal banking system. That's right. You're going to be the bank, and that is incredibly powerful. But in being the bank, you gotta treat your money the same way you treat the bank's money. But over time, if you apply that discipline that we talked about as a negative, as a con, you will start to learn how this works. There's plenty of videos that I do. Matter of fact, right now would be a great time for you to subscribe to this channel. Right below, click subscribe, okay? Right here. Yep, click it. Just push the button. So, moving on. Do you like paying taxes? I mean, come on. Every year, do you like paying taxes? When you make money on your savings account, which, sorry, I didn't mean to hit it below the belt, but you know, that little bit that you make, like less than 1% for most of you. Yeah, and then at the end of the year, the bank just happens to send you a 1099 INT. That's right, so that peasily little interest that the bank paid you on your savings account, they also tax you on it, because, oh, well, that's a gain, right? But you don't like doing that. You don't like paying tax on any of your money. None of us do. So in this, it is tax-free if built properly. So if we build your policy, the specially designed and engineered policy, okay, it'll be tax-free because we know how to build them within the MEC 7 pay rules, the IRS rules. But not only is it tax-free, it continues to grow tax-deferred. So as your money keeps compounding year over year with all that interest and dividends and all that extra money you're putting in, it keeps growing, keeps making interest, keeps getting dividends, but the best part is it's all tax-free. And every time we take that loan out to go work, you know, paying off your car, paying off your debts, maybe investing in real estate, whatever you want to do with it, the opportunity, the monopoly opportunities that we talked about, all those loans that you take from your policy are potentially tax-free and they grow tax-deferred. So that's a huge advantage. Why do you think the wealthiest families in history have used this? Well, they don't like paying taxes either. But not only is it tax-free, it's guaranteed. 100% guaranteed interest contractually. Now, let's compare the guarantee you have with the giant mutually owned insurance companies versus what you think might be a guaranteed interest rate from your bank. I remember there were banks, I'm not gonna give any names, but online banks that were paying 3%. Everybody was running to them until the Fed dropped interest rates and all of a sudden their bank was now paying them close to zero. Oh, that's right. But the policies aren't just guaranteed to pay an interest rate today, they're guaranteed to pay that same interest rate for your entire life, contractually guaranteed. But let's keep going on. I love this one, number 7, private. No reporting at the end of the year. Number one, it's a tax-free environment if done properly, so I don't have to report it for taxes. Nobody needs to know I have this. Whatever money I have in my private banking policy, my specially designed whole life, is my money. I don't need to tell anybody, it's private. And to me, that's really important. But you know what else that's really important to wealthy families like Rockefellers and Rothschilds? You don't even know what they're worth. And you never will, because most of their assets happens to be sitting in this, and they don't have to report any of it. So when you hear, oh, the Rothschilds are worth this, or the Rockefellers are worth that, yeah, you probably have to add a couple zeros, because this is a private asset. So, next, creditor protected. You think we live in a sue-happy world? A world where people just love suing people? When I used to own my skateboard, snowboard shops, I hired this construction company, and they were fully licensed and insured. Big deal, right? They had all the markings on all their trucks, and all I needed was a sign put up. I had my Fat Man sign up there, and I wanted to put surf, skate, snow underneath it. So it was just this box that they had to put up. I'm in New York, so this is different than other states, but the guy fell. I don't know how. If you ask me, I think he just jumped and did this intentionally, and he broke his wrist. He sued, and he got paid. But here's the one thing he didn't and never could have went after. He never could have went after any of the money in my private banking policies, because they're protected against judgments and liens in most states. So, an unbeatable case, the ladder law. The dude got paid. He got paid all the money in the insurance policy that they would pay out. And then he kept suing, because then, all of a sudden, he now had neck problems and back problems and everything else. But he never stopped working. It's funny how that works in this country, isn't it? Everybody's looking for a free handout. But you know what? I bet you all of his money now is gone, and he's probably back to working and looking for that next ladder to fall off of. Coming to a theater near you if you hire that company and he falls off the ladder. Hopefully not. But all this is protected against creditors. So when we really look at this and we say, let's look at the pros and let's look at the cons, we really have to determine which one works for our needs and goals. And I'll leave that up to you, which one works best for you. I hope you enjoyed this video, and if you like this one, check this video out, because it'll teach you all about the infinite banking concept, BYO Bank. I'm Chris Naugle. Thanks for joining me for another episode of What Now? What's Next? See you next time.